Hey, what's up, everybody? Super glad to be back. I really appreciate all the support and all the love, all the views for the last video. It means a lot. But today I am coming back with something that's really awesome. We're going back to the stock market, back to the investing space, and we're really going to be focusing on the differences and the different aspects of being a trader and an investor. And there's always that possibility that you can be both a trader and an investor at the same time. Although there are different aspects to it, there's a lot of different things that are similar and a lot of things that are different. Firstly, we're gonna dive into what a trader is. So now, first thing, stereotypically, these traders are a lot younger, the younger crowd. They're more taking risks because since you're younger, you have more time to take those risks, more time to deal with the ups and downs. So first off, we're gonna start there. Young and more risky, I'd say. Some qualities of these traders would be the more risk takers, first of all, more short term plays. This would be, say, you're doing more swing trading. You're buying a stock today, selling it tomorrow, buying it today, selling it the same day, buying it now, selling it in a month. So that's kind of the plays that we're talking about with the short term plays. The goes with market swings and usually analyzes graphs. This is huge for these more traders. The trader typically is looking at the graphs, they're looking at the ticker marks, they're looking at downtrends, uptrends. They're trying to see how they can play the market. They're not really looking at the company's balance sheet. They're not looking at the company's morals and values. They're not looking at where really the future's gonna be. They're looking at news articles that are right now, incoming IPOs even, or they're looking at all these catalysts even, which leads to the next point. Typically follows the news cycle and looks for new catalysts. This is huge for them. This is their bread and butter. You know the rumor. Buy the rumor, sell the news. Said that a little too fast, but yeah, buy the rumor, sell the news. It's really what it is. They're buying the rumor, they're buying what's happening, they're building it up with the news, and then they're selling, making that quick profit with the being more of the trader. And lastly, swing trading. I think this is awesome. This is one thing that I really like doing actually, because you can swing trade with these blue chip stocks or these great growth stocks too. You can swing trade those. So I think once you open the door to swing trading, there's a lot more that you can do with your time and with your money to be the best you can be. Now, with being the trader that we're talking about, it really opens the door to analyzing a lot of data. You know, the ticker symbols, what's going on, the market volume, the volatility at the time. And it also allows for you to really look at the news cycle and really follow what's happening and look at upcoming catalysts. Overall, in the end, a good trader is looking for undervalued stocks where they can see a quick profit turnaround where it goes up. So this is perfect for swing trading, undervalued and then overvalued, overbought. This is great. This is literally bread and butter to them. Buy it here, sell it when you make that 5% gain. There it is. Now, number two, now we're on to the investor. Now, this stereotype is normally going to be a little bit older, not really a risk taker. These people are really planning ahead for their trades. They're really analyzing all the facts of the matter, and they're trying to really they view it a different way. They don't see these stocks as graphs. They see them as actual companies. So with that, the first quality I would say of an investor is generally more risk, as we said earlier. Secondly, they're in it for the long run. They're in for these blue chip stocks that are going to go up, that have already proven themselves, a solid balance sheet, and they're looking for these growth plays that are really going to continue to grow in the future and to get the benefits from all those growth plays. Three, they're looking for big growth stocks, and I just said that, but under that, I would say two growth stocks that are pretty solid right now. As you guys all know, Apple, technology giant, huge, and then Shopify, which is a business that helps other creators make their own businesses. Really helps a lot of people out. And these are two great growth stocks that I see growing in the next 5 years, and what a lot of people do see that too, and they're trying to invest in these stocks. Now, number four, we're looking for ETFs. A lot of these investors like looking at ETFs, which allow for great growth along with different sectors. So when you buy into these ETFs, normally they're only going to go up. Really, they'll have some down. It's a lot less risky, so it's not going to go up as much, but it's going to go up generally for the most part. And another thing with these ETFs, you can invest in different sectors, which then helps for your diversification, which is huge for an investor, being diversified and being able to seek the benefits of all these stocks and ETFs at once. Number five, investing because you believe where a company is going in the future. Now, this kind of goes along with the balance sheet, seeing what's happening in the past, seeing what their morals and values are. If you get a really solid company that is putting in the effort and working really hard to be the best that they can be and be innovative, especially in today's space, everything is becoming so innovative, so competitive. That's where you want to be. You want to be in those growth plays that have proven themselves and that are going to continue to keep proving themselves. And you need to set your own price targets. The investor is really good at this, setting price targets and staying really stomaching the volatility because they don't really care. They're in it for the long run. Now, lastly, the last point for the investor is going to be number six. Another category of stocks investors like is high dividend paying stocks. Dividends are huge. A lot of investors love dividends. Really, those are solid blue chip stocks like AT&T. They pay great dividend yield, 7%, 6.4 maybe right now. So what the investor does, they like doing is buying these stocks when there's at a discount. So with these recent dips we've been seeing, they love this because actually they get more bang for their buck because they get 6% of this $30 stock. But if it goes down to $25, they're getting 6% of this. So you can actually get more money from those dividend yields, which is huge. And investors love this. And it's another way to diversify into different things. Now, overall, the good investor is going to be looking for these really solid, promising stocks that are really great for the future, along with ETFs, dividend stocks, and for greater diversification. So they really want to be diverse, not risky. They're looking for that solid 7%, 8% growth every year, and in the end, that's how you become rich, right? Save, invest, get that 7-8% gain, and keep building on that. Especially if you're making these plays great, especially with dividend stocks, ETFs, and growth stocks. There's a lot of room for potential growth. There's ways to do each actually. So this is what we're gonna hit on now. The way I see things, I personally think I'm a little bit of both. I love looking at the speculative plays, being more of a trader, and I love being the investor. I love learning about these blue chip companies where I see them going in the future, and I love playing the catalysts. So that's what the trading is. Really. So I would say that a great portfolio is one that is focused more on the investing side. Like you want to be safe. I would say being safe with your money is very important. But at the same time, you can put aside X percent for being an investor, and then X percent being a trader. Because you do like making those trades. I love going on my Robinhood app and making those trades every day or weekly or monthly, and being so invested and involved and being like, all right, I'm seeing this news cycle happening right now. These stocks are about to crash. I'm gonna hop in right now, and I'm gonna see it go up 10%. These are things that really excite me, and that can excite you too. So you put X percent into the investments, X percent into the speculative plays, and you go from there. That's how you be both. In the end, doing this, it really comes down to risk management. This helps you be this risky or this risky. It helps you with higher potential, but also higher downside, or lower potential and lower downside. It's all really who you are as an investor. It's not better or worse to be either or. There's really pros and cons of each, which hopefully we laid out some good pros for each. We didn't lay out any of the cons, but that's not really what we need to know. We just want to know who we are as a person. Are we more risky, or do we like always doing that data research and we love looking at these the charts, or do we just like these solid companies? Or like ETFs or dividend stocks. There's a lot of different personalities. And for me, I'm both. And for you, hopefully you find what you are meant to do. Anyway, in conclusion, really, I think that it's really important to give both these an equal look and analyze who you are as a person, and really do your own research and own it. The only way you're going to own it is by doing your own research and being the best you can be for yourself. And right now, this is a great example of that, watching this and knowing this is what a trader would do, or this is what an investor does, and this is what I like doing. So I think those are the best ways to really grow in this space and to become more comfortable in where you're at. Because I would say something that's really important in investing is being comfortable where you're at. I know you can be uncomfortable with how your stocks are doing, but being really comfortable where you're at currently is going to help you stomach through the volatility. Whether you're a trader or an investor, you are going to go through some red days, and you're going to go through some green days. So it's all going to be worth it, but you need to know where you're going. And this is why I really encourage you guys to set price targets for both being an investor and a trader. For traders, it's, I'd say, a little bit more common because you're setting the price target. You're like, I'm going to sell right now, and I'm going to sell if it gets down here. You're high and you're low. With the growth, you're going to stomach that stuff out. But still, it's really great to know where you're going to go in the future. And then if you do hit your price target, you need to really reevaluate and either sell half your shares, or keep half, keep all of them. You never really know. Just have a plan. What I'm trying to say is have a plan. But anyway, thank you so much for watching today's video. I'm really happy that I could get this out because it's really important for you to know who you are and what your qualities are. It's really important to know what you're all about. But anyway, do your own research, do the best you can for yourself, and thank you so much for watching all the way to the end. I really appreciate it. So drop a like if you liked it, subscribe, comment. I read all the comments, all a few of them. And yeah, thanks for watching to the end. If you didn't like it, it means a lot. So anyway, have a great day. Peace.